whole thing is looking for those patterns hidden just beneath the surface. And today, we're diving into a really interesting one. What if the stock market isn't reacting to today's news at all? What if it's actually responding to a future that, well, that hasn't even happened yet? It's this strange paradox, right? You've probably noticed it. The market will suddenly soar when the news looks absolutely terrible, or it'll take a nosedive when everything seems to be going great. It really makes you stop and think, is the market looking at today's report card, or is it trying to listen to whispers coming from tomorrow? And this is exactly what we're talking about. You see headlines like unemployment jumps, and then you see the market rally, or GDP growth is fantastic, and stocks fall. So it's pretty clear the connection isn't a simple A to B thing. To really get why this happens, we have to look deeper, way below the surface of the headlines. Okay, so to solve this puzzle, we first have to learn the language the market is actually speaking. And it's not a language of words. Not really. It's a language of signals. There are these four key currents that are constantly, quietly shaping everything. First up, you've got GDP, or Gross Domestic Product. This is the big one, the broadest possible measure of an economy's health. Think of it like the speedometer on a giant economic engine. Is it speeding up? Is it slowing down? This one signal gives us a really powerful read on the entire economy's momentum. Next, there's inflation. Now, this is the rate at which prices are going up, and it's so critical because it tells us how quickly our money is losing its value. Analysts at places like JP Morgan talk a lot about sticky inflation. That's when it stays high, putting this incredible pressure on everyone and really tying the hands of the central banks. And that brings us to the main tool they use to fight that inflation: interest rates. This is, put simply, the cost of borrowing money. Think of it like a gas pedal and a brake for the economy. Higher rates act as a brake to cool things down. Lower rates are the accelerator. And the decisions they make here, they send ripples through absolutely everything. And finally, there's unemployment. This isn't just an abstract number, it's a direct measure of how the average person is doing. When people have jobs, they have money and they spend it. But as reports from JP Morgan's Outlook have pointed out, a soft labor market can be a really serious early warning sign that trouble might be on the horizon. And this quote here from Fabio Bassi at JP Morgan just nails how interconnected all of this is. See, these signals don't exist in a vacuum. A decision to help the economy and boost jobs can also cause that sticky inflation we talked about. It's this incredibly complex web where a pull on one string can make another one go tight. But here's the thing. Knowing these four signals, that's only half the story. Because the economy isn't just some machine humming along with numbers and data. It's a system that's run by people, by us. And that's where things get, well, really complicated. For the longest time, the main idea was something called the efficient market hypothesis. It basically assumed that we all act like perfectly rational robots making logical financial decisions. But a much newer field, behavioral finance, gives us let's say, a more realistic picture. It says, hold on, our collective emotions, our biases, our fears, that's what really drives the market, especially when things get chaotic. And this research has pointed out some very predictable glitches in our thinking. There's herd behavior, just following the crowd. There's loss aversion, where the pain of losing $1 feels way worse than the pleasure of gaining one. Overconfidence, where we think we know more than we do. And extrapolation, where we just assume that whatever's happening now is going to happen forever. And you can actually see this in the data. Just look at this slide for a second. In normal times, we tend to hold on to our losing stocks, hoping they'll come back. But during a crisis, that behavior completely flips. Panic sets in, and we just rush to sell everything. You can also see that herd measure, showing how everybody starts moving in the same direction at once. In those moments, psychology isn't just a factor, it's pretty much the only thing that matters. So you have these cold, hard economic signals on one side, and you have the messy, emotional, unpredictable world of human psychology on the other. When you finally put those two pieces together, you start to see what the market is really doing. It's not a mirror reflecting what's happening today. It's more like a crystal ball, trying to show us the future. And this right here, this is the core idea. The stock market is basically one giant forward-looking prediction engine. It's the collective bet of millions of people on what the world is going to look like 3 months, 6 months, even a year from now. It's always trying to get out ahead of the curve. So here's how that plays out. First, based on all those signals we talked about, the market forms a collective guess, an expectation. Let's say everyone expects inflation to be 3.1%.
Now, here's the key. The market prices that expectation in before the real number even comes out. So when the official announcement happens, the market doesn't react to the number itself. It reacts to the surprise, the difference between what was expected and what actually happened. And that's exactly why bad news can make the market rally, if it just wasn't as bad as everyone was afraid it would be.
And this constant dance, this process of forming expectations, being surprised, and then adjusting day after day, is what creates those massive patterns we see over time. You know, the huge bull and bear markets that end up defining entire eras of financial history. These big cycles, they're not just random noise. A bull market is really just a long period of time where our collective bet on the future is positive, and it's getting more and more optimistic. A bear market? Well, it's the exact opposite. A long stretch where that collective expectation turns sour. They are the visible waves created by these invisible currents shifting deep below. So, if you take away one thing, it's this. The market is always looking ahead, pricing in what it expects to happen. Those expectations are built on those four key signals. Our own human psychology then causes us to overreact whenever reality serves up a surprise. And those big market cycles, they're simply the result of all these powerful forces working together. So you see, the market isn't just random chaos. It's this incredibly complex system constantly responding to these deep, unseen economic currents and the predictable, quirky patterns of our own psychology. And real, deeper understanding, it begins the moment we learn to stop watching all the noise on the surface and start observing the patterns moving underneath.